You're a parent with a student at the University of Guelph, and you're considering purchasing a Guelph student rental, then this video is for you. I'm going to provide a step-by-step cash flow analysis to try to make that decision easier and shed some light on what is a wonderful investment. So this is 141 Janefield Avenue. It's available on MLS about 3 weeks ago and was purchased for $750,000. I'm over here in column J. We've made some assumptions just with the total mortgage required, and we used a down payment of 20%. So assuming a 30-year amortization at a 4.44% fixed term over 5 years, we get a monthly mortgage payment of $3,004. So including that down payment, land transfer tax, legal fees, and renovation expense, we've got a total investment here of $182,963. That renovation expense is an assumption, of course. You can go a little higher, go a little lower. Because we're charging $1,100 per month in this example, it's always recommended that you provide quality back to your tenants. That's going to allow you to pick who you are providing that service to, and it just makes that experience a lot better for everybody involved. So this example is for a 6-bedroom townhome in which the parents purchased it for their son or daughter. They've rented it to 5 of their friends at $1,100 per room, or $5,500 per month gross monthly rental income, for an annual $66,000 per year. So our spreadsheet now, we're in column B. We'll take away all of those annual expenses. So mortgages, property tax, property insurance, utilities shared as that son or daughter lives there, CIE condo management. So if it's a condo townhome, that means that snow removal, grass cutting, building insurance, things like that are included in that condo fee. It's great for out-of-towners. It makes it a lot easier, especially with grass and snow usually being a bit of a sticking point with student rentals. So that expense is included there in row 23. And we've also included repairs and maintenance and other future expenses, or if any HELOC interest, things like that are being used, that's included there. So that totals right around a little over $4,000 for the year. So a strong contingency being used. Once all those expenses are calculated and taken away, we can look at our net operating income. So in this example, again, with 5 students and your son or daughter not paying rent, you're at a net operating income of $13,844.93, or a monthly cash flow of $1,153.74. So a really strong cash flowing property there. For instance, you wanted to have 6 renters in there, you've got a $2,200 a month cash flow, and it's an absolute machine just in terms of that cash on cash return. For this example though, we'll stick to the 5 and we'll just run it as though your son or daughter is going to live there. So again, for $182,000 total investment, we're looking at cash on cash return in year 1 of 7.57% and an annual cash flow target of $13,844.93. Let's head on down and see what those annual earnings are going to look like. So we've already spoken about the cash flow, but we're making an assumption here that there's a $600,000 mortgage that's been brought in to help purchase the property. So with our structure of $600,000 at a 30-year amortization and 4.44%, you have to calculate how much principal pay down you're getting when your tenants are paying that down for you. So in this example, it's an equity ROI of 5.89%, or $10,778 every single year that's coming off of your principal mortgage. So when you take that with your cash return and you add it to your equity ROI, you're getting a total return on investment of 13.46% every single year. That's against the $182,963 that it took to purchase the property. So a very solid return there in that first year. This also assumes that the property has not gone up in value at all. So we're buying this based on really good principal here. Coming down into our 5-year earnings review, we've included a $15,000 major expense contingency. That's outside of the amount of money you're already reserving in the spreadsheet numbers above. So we've already got that here on line 24 and 25, that $4,000 per year number. There's $15,000 over the 5 years. It's just going to help balance any kind of risk, and again, it offers that safety net in case something does happen with the property. So our new analysis is being completed on $197,963. 5-year cash flow we're looking at is $69,224.65 for a cash ROI of 34.97% and a 5-year equity earnings debt paydown of $53,890 or 27% return on investment. So adding that all together over the 5 years, if this property does not go up in value 1 penny, we're at 62% return on investment or $123,114.65. So a really healthy return here. Again, you're purchasing this property in the city of Guelph where there's no student ghetto. These properties are shoulder to shoulder with single family homes. So to expect a little bit of appreciation would not be unfounded. It's definitely to be expected, especially over a 5-year period. But this property is still with really sound cash flow and debt paydown principles. So let's take a look just on line 51. If we do include a little bit of appreciation, we've gone in with just under 3% here. We're at 2.94%. If we were to increase over 5 years, every single year, non-compounded. So we bought the property for $750. In 5 years, if it's worth $860,000, that's how we're getting that number. So 5-year cash flow, 5-year debt paydown, and 5-year appreciation. That gives us a total ROI of 112% or $222,774.15. So a really solid number here if you're considering purchasing a student rental property for that 5-year period. Another reason that you might consider this investment to be, something that is really strong is that students, Margaret, they've finished that chapter of their life after 5 years, then they graduate. So after this investment has totaled that $222,000 return, you're going to get yourself a fresh group of students at a new market rate. So presuming that $1,100 per month number is higher, or $1,100 per student is higher, you're going to see that asset climb in value more and more. So that's our analysis for today, guys. Again, a great property in the city of Guelph, really close to the university and with a great corridor. So yeah, if you enjoyed this video, guys, please feel free to like, please feel free to subscribe. It encourages me to continue to make these videos. I really enjoy doing it. And again, have a wonderful day. Thanks for watching.